Derek. How are you this morning?
Good morning,
Great.
James.
Yeah, you doing well? Getting through the month of July and summertime.
Summertime, yeah, it's a fleeting moment here for us Midwesterners where we get a couple good months of weather that allows you to be outside enjoying it. So
Next thing we know, school's back, right?
yeah, that's exactly right. So, but hey, one thing that keeps trucking right along are the capital markets.
Right.
That's what we're here to talk about.
Thanks for joining us today. And Ryan, let's just kind of jump in right there
Yeah.
with what the markets, where we're looking. How was July?
July 2024 started with one tone and finished with another. And really, it all kind of came pretty quick. There's a Lenin quote that I do a monthly video to my clients, and I led with that. There are decades where nothing happens, and then weeks where decades happen. Something to that effect. And it really felt like July, the end of July, was where we got a lot changing. And remember, we talk about when the winds change, we need to adjust the sails. Not really catching us by surprise. You never really know when the market's going to react to something. But it was a pretty monumental and pivotal month. So right now we're just talking about how the different structures did. So stocks, bonds. We like to look at the S&P 500. Top 500 companies in the U.S. to determine how did bonds do for the month of July. So we finished with a positive return. Might not have felt like that because if you checked your balance right mid-month, you'd have thought, gosh, it seems like I walked back a decent amount. Well, sure, but recognize there's always going to be intra-month volatility. But we did finish July out with the S&P up 1.22%. So we'll take that as a win. And again, a lot of volatility re-entering in that month. Bonds. In fact, some of the reasons that we saw the volatility in the stock market helped bolster bond prices. Now, remember, bonds, generally speaking, are when an investor is lending money out for a stated period of time at a stated rate of interest. So imagine if I lend money out and I get 3% on my money. Let's just say arbitrarily 3%. For 10 years, right? And then a year goes by, I got 9 years left on this 3% bond, but interest rates go up. Now, new bonds are at 4%. That's the new 10-year bond. Well, who's going to buy my 3% with 9 years left on it? I have to cut the price down to move the product, if you will, right? So that's why, generally speaking, bond prices and interest rates move opposite one another. Well, towards the end of the month, we saw interest rates recede here in the U.S., and there's a lot of reasons why, which we'll get into deeper in the podcast, but that boosted the general bond market, the aggregate bond index, actually to a 2.34% increase. So we saw bonds outpacing stocks, which is not something we've talked about a whole lot here.
Right.
But, not all bonds are created equal and what have you. That's just the bond index. So what we're doing for clients is a little more tactical than just index type investing.
Well, let's think about that kind of tactical approach, right? Yeah. So we're obviously, we work with clients. We, try to do what's in their best interest at all times, right? But when we're looking at portfolios, maybe where we're going to lean in or lean out, if we look at the portfolio specifically, was there anywhere that we did lean out, lean in?
Yeah. So for those who recognize that stocks tend to move with more volatility than bonds if you look at historical just characteristics. It doesn't mean that, from my perspective, and we've talked about this before, it doesn't mean bonds are less risky than stocks. They're just inherently different. So for those retirees or those approaching retirement that are looking for income, because after all, when you leave the workforce, you need a new source of income.
Right.
Think about that. Lend money out for 10 years at 3%. Well, that's an income stream. So for those who need that fixed income, we've tactically been rate neutral, if you will. As we're trying to fight inflation, the Fed is going to be raising interest rates. There's a lot of volatility around that. So as we start to see the Fed backing away from the movement higher in interest rates, as we're starting to hear them communicate a channel of perhaps relaxing those interest rates, we made some pivotal changes in that section of the portfolio for those who have bond exposure and are feeling more able to hook up with what's called duration. It's a little bit more bond interest rate sensitivity. And quite frankly, that will help too if we're turning a corner and seeing the economic data points turn down a little bit. And got a little bit of a cheat on that. And what that is just remember where the data was a year ago. And then you kind of have an idea of where things are at today. So when the print comes out, you're prepared. And when I say print, we oftentimes will get, 1 month, year over year, just economic variables that come out. They're printed, if you will, in the press, and then the market reacts. So that's how we're trying to get a leg up on things. We saw about what we expected from the Fed, and so again, just making sure that we're notching the portfolio to, skating to where the puck's going, not where it is right now.
So stay nimble. We always kind of
got
talk
to
about that.
yeah.
And we've kind of rolled through this great Financial Sense podcast and topics, and I know we kind of self-evaluate all the time, right? Where we got it right, where we got it wrong.
Right.
But if you would have tuned in last month, we actually talked about remembering how this environment felt, two sides to risk. So I guess let's kind of look at that, and kind of revisit it.
We referenced a Google search.
Exactly.
Stock market crash Google searches were at all-time lows, and that kind of led into the volatility that we were prepared for.
Yeah.
Not that we did a dramatic reduction of stock exposure kind of before the Fed meeting, but we recognized that we had come a long way really
Paying
fast.
attention.
And it's just, again, it's healthy. It's healthy.
Right.
And that's really important because risk can happen slowly and then all at once. So again, what your goal is, and I've talked to you guys about this, and I hope I'm not getting ahead of ourselves here, but when you're looking at portfolio management, it's kind of like living a healthy life. You want to practice habits that will keep you out of the doctor's office looking for a prescription. That is, notching moves as they make sense. Being, you don't have a crystal ball, but you're making high probability executions within a client's portfolio. That's what gives them the edge. So it's this living healthy, being proactive and anticipating, where things are headed. If you think about it, the healthy living, your goal isn't to, from my perspective, my personal health, I'm going to try and eat right. I'm going to try and get some exercise. And it gets tough with the fire hose of data we get to drink from every day. But, the goal is to stay out of the doctor's office when you could say, well, I eat whatever I want. I do whatever I want. And then if I get sick, I go to the doctor, I get a prescription, and I handle it. That's not proactive. That's reactive. Our goal with portfolios is health, hygiene. And so some of these moves that we're notching, it's analogous to that.
Yeah, consistent practices.
Exactly. And so what we just went through, we had already adjusted for a little bit. It's just that healthy living.
Yeah.
Well, we just kind of touched on it, right? We've had an extremely calm year so far in the markets. And so, again, going back to that Google search, right? Some of the least amount of times that people are searching for recessionary periods. And finally, at the end of the month, we started seeing some volatility. And, I guess the question, as far as our long-term story goes in portfolios is has this recent short-term volatility that we've seen spiking here at the end of the month a cause for a long-term strategy shift?
Nah, right. We're on the boat. The winds are blowing. To get the boat to, the destination in the best way possible, we want to adjust those sails so we're hooking up to the wind properly, and winds change. And so our goal is to move with the wind so it doesn't really disrupt the long-term message of staying invested. But Derek, you're onto something. Things have been very benign from a volatility standpoint this year. And then all of a sudden you see this spike in volatility. Part of this healthy living, we run what's called like a multi-factor approach to portfolio management. We're looking at a lot of different things here. One of those things is volatility. We wake up every day and we expect that owning a portfolio has risk associated with it. That risk we can quantify with a volatility profile. But what if we were to look at the volatility of that volatility profile? When you start to see that ramp up, you know that you're coming into a venue where you could have some pretty high volatility. Now, how do we arrive at that? How do we know when volatility is ramping up? A lot of it has to do with the options market, and it's for a different podcast, not this one. But I guess where we'll go with this is recognizing that we were in a space where, the volatility of volatility was really rising, and then you see this big volatility event. And it starts in the month of July. And I'll tell you, when you have a season that volatility is ripe for, you have to watch out that it will perpetuate. It's not just a one session type of thing. We have to kind of watch out for that. So in the short run, volatility spike. It happens. It's part of the journey. Markets pull back, but long term, no, it really hasn't changed anything. And one of the, for those who tune in every month, we've continually talked about the fiscal stimulus that we're experiencing right now. So there's two levers that our policymakers can pull. Monetary policy is acts of the Fed. Fiscal policy is really acts of Congress. So, government spending, taxation, things like that. One of the things that just kind of came out recently was the fact that we're going to run not a $1.5 trillion deficit as a nation or 1.4, well, $1.9 trillion. So just shy of a 30% increase in deficit spending here in the U.S. for 2024. That's very stimulative. That's basically spending money that we don't have, and we'll go hit the treasury market to raise that money. Think about this. I talked about $1 trillion. It's hard to wrap your head around.
Yeah, right.
Recognize a $1.9 trillion deficit. That's stimulative. Okay, so how stimulative? Well, let's just, somebody did this to me the other day, and I thought it was really cool. 1 million seconds is 12 days. A billion seconds is 31 years. 1 trillion seconds, 31,688 years. Taking you back to before the Ice Age.
Right.
We've...
It's pretty incredible when you think about those kind of numbers,
I mean, so look at this. We're spending $1.9 trillion of money.
How does it not stimulate?
Okay, so that is stimulus. So I guess when you look at the longer term, it's going to take an awful lot from whether it's the economy just turning down, to kind of break through that. So recognize volatility happens. Traditionally speaking, the market pulls back 5% a few times a year. You'd expect to get a 10% pullback once a year. Volatility happens, so let's
routine decline.
Well, and it never feels good either, right? The
No.
clients, for anybody, that volatility never feels good, and it brings back the bad memories of a market crash in 2008 or 9 and, what happened during COVID and things like that. And so, I think people kind of get up in arms about it. But with volatility, that can also create opportunities in the market.
Yeah.
And so do we see anything in the market that we're looking at for just opportunity given the recent amount of volatility?
Understand?
Yeah.
I've been doing this a long time. You guys have been doing this a long time. One of the things that strikes me is, somebody's imagination is almost their biggest hurdle when it comes to owning, a higher risk portfolio of stocks. Remember, when you own a stock, you own a company, you are an owner of business. The market just it's like an auction for that share of your business day to day. Well, guess what? Lowballers show up to auctions, by the way. Remember what you own. So when you're talking about opportunity, absolutely, the volatility gives us that opportunity. So for so long, we've been focused on protecting clients against this rising interest rate environment. All of a sudden, we saw interest rates dive, and all the things that would have led up to the anticipation of that, if you're paying attention and putting that to work, you can start to gain edges. So yes, Derek, there is tremendous opportunity in this volatility. What you can't do is allow your imagination to run wild and bring you back to some of those really challenging times. Because if those really challenging times do come upon us, I know risk can happen quickly. There are ways we can anticipate some of these weaknesses, and not always. You have tail risks. I mean, geopolitical events, things like that. You got to watch out for that stuff. But we always have an escape plan, and you just got to stay committed.
Well, and one of the things that we all talk about too, that water cooler talk, right, is don't fight the Fed. So in July we had a Fed meeting, and what was the tone of the Fed? Jerome Powell decided to hold rates where they are, but kind of indicated that we're getting to a point here in the near future where we may start cutting interest rates. You've got banks starting to predict maybe a 50 basis point rate cut in September, 50 basis points in November, maybe 25 in December. And so not asking you to predict the future here of rate cuts, because that's not what we're doing. But, if the Fed does start cutting rates, what does that mean, or how are we going to plan around those sort of upcoming anticipations of what we're doing in the market?
So that's just it. It's the gorilla in the room. When does the Fed start cutting rates? Everyone's clamoring for it. The Fed hasn't been really great with anticipating where the economy is going. I think that they're just about as lost as anybody else out there. The banking world, not been tremendous, but I think that your point of don't fight the Fed, even if they get it wrong, they're still going to do what they're going to do. It's, the idea is that when you start to see inflation settle into not where prices of things are going down, but they slow going up, the Fed feels that they're at a neutral interest rate environment or restrictive interest rate environment. They've slowed the economy down enough to arrest the inflation. They can start to relax their interest rate policy. Be careful. And we've talked about this. Sure. Be careful, because interest rate cuts up here, theoretically, they're stimulative. Yeah, they're stimulative because there's units of weakness in the hopper, so to speak.
That's right.
The Fed is looking at things down the road, and they've got access to data that we don't. And so they're cutting because they see units of weakness down here. So you could almost say they're offset. What you're trying to do is get a drop on when does the Fed go beyond the weakness. The weakness is maybe already reflected in the data, on the numbers, and then they keep cutting. That's typically a more aggressive cut cycle. The first couple cuts up here, they don't mean a lot. No. And what they actually admit is that there's weakness. So think about that. Everybody's been clamoring for these rate cuts, and rate cuts, they are stimulative when it matters. Right now, I don't know that it matters a whole lot. And in fact, when the Fed does cut, it's acknowledging that weakness. We might have got a taste of that in July.
Right. We always tell our kids, well, at least I tell mine, be careful what you wish for.
Yeah. Well, and we've talked about that on this exact broadcast,
So as we kind of look at all these different topics, and even this year, it's a topic that we've had in the past, but it seems like we got a mixed bag of economics, of data, of situations, of the tone of the Fed. But where do we stand in this mixed bag of the economy?
Yeah. It's hard to look past that fiscal stimulus lever.
Yeah.
And so I think that some of the volatility that we might be catching here is positioning for, obviously, the big catalyst of an election later this year. Recognize the markets. Right. Go figure. The market is a forward-looking mechanism. It's a discounting mechanism. It's trying to discount a future environment into today's terms. So, you're already seeing the hedging taking place around the election. You're seeing a lot of put buying out there and things like that. So some of this volatility might be because of that. But another thing that could come out of the election is, what does the construct of that fiscal policy decision making look like? And if that is the big driver of, growth, the unemployment rate, it's ticking up a little bit, but my goodness, all the government and state level jobs and stuff,
right?
It's all coming out of that just massive fiscal stimulative environment. And so does that change? That's going to be really important. I've got a call with an economist later today to talk about their perspective on that. Yeah. So if that continues to remain in place, and that should bolster a lot in the economy, it'll allow the Fed, if the Fed then kind of backs off, we've got some positive things. But I do believe we're at a bit of an inflection point, at least in the short term. Recognize long term, you stay invested. Yeah. It's the right thing to do.
Stick to the plan.
Yeah, but it's, be prepared for some chop. And we certainly are.
Well, let's look ahead to that then.
Yeah.
Right? Kind of getting into August, volatility.
Right.
As we get closer to the election, we get closer to the Fed's next meeting,
right.
As we kind of move ahead and look ahead to that.
I see this is kind of a thing that I'm going to put on record here. I almost see where we get the data slows a bit from an economic standpoint. It looks like things are deteriorating. The Fed can get their cuts done. But then, and again, what I'm looking at are comps. So rolling 1 years.
Right.
But then I think towards the end of the year, the way the comps look, you might see inflation reinvigorate. You might see rates have to come up in anticipation of fighting that.
Yeah.
So lull to reacceleration. So we just continue to drink from the fire hose of data that comes out daily. We navigate to the best of our abilities to give you an edge. That's all we need.
And we'll come back here and talk about it.
That's right.
That's right.
Well, Derek, Ryan, thanks for sneaking in, and thank you for joining us. And we'll see you next month.
See you next month.
Gentlemen.
Advanced Capital Management Incorporated is a registered investment advisor. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk, and unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor before implementing any strategy discussed herein. Tax and estate planning information should not be construed as formal legal or tax advice. Always consult an attorney or tax professional regarding your specific legal or tax situation. Thank you, and we look forward to seeing you next month.